So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, Kirk here again, and welcome back to The Daily Call. Today's call focuses on how we can use option strategies to protect gains. And this is mostly for stock investors. I think that this is important just as we kind of wrap up February here, because February was such a volatile month. We had so much volatility, particularly in the beginning of the month with stocks falling really, really hard. And so people are now asking, and we're getting questions, and we see it all over the place. How do we protect ourselves from gains? If we had a stock portfolio, how could we have protected some of the gains that we had? So there's a couple ways you can do it. We'll kind of cover three general strategies. There's obviously a lot more that we can cover in other podcasts, but I'll kind of take the top three, or not top three, but the ones that are most often talked about. The first way that you could have protected gains is with a long put option. So if you're long stock, and we'll assume for the rest of the podcast here that you're long stock, if you're long stock, one of the ways that you can protect your gains is with a long put option. Now, in the case of the markets heading into this recent sell-off that it had, if you had a long put option, because volatility was so low, it probably didn't cost you a lot of money, meaning the insurance on that option was probably actually really low. The volatility premium was pretty low, so it probably didn't cost you a lot of money. The trouble with put options is that if you have to maintain that insurance, meaning you buy that put option, month after month or quarter after quarter, it does become costly and it does start to eat into your potential profits to the point in which it doesn't really make sense to do it unless which who really knows when the market's going to sell off, unless you know that a sell-off is coming. The second way to do it is to do a short call option or a covered call. This has historically been much better than doing the long put option strategy, because when you are in situations where you don't know if the market's going to sell off or not, executing a consistent and rhythmic covered call strategy to reduce cost basis is a great way to go about it. Now, it's not going to protect you and totally hedge you from the markets going down like we recently saw, but it does reduce the cost of ownership. So again, if you're long stock at $100 and you can sell a covered call for, say, $1, it reduces your cost ownership down to $99. You do that consistently month in, month out, you can start to cut some of the premium out of your cost basis in the shares so that at the end of the year, say you've collected $12 in premium. Now, if the market goes down, 10%, you're still okay. You still actually are making money because of that covered call that you've been consistently selling on that stock. So again, it's a different way of going about it. It doesn't protect you totally from the downside like maybe a long put option would, but it's a better income-driven approach when you don't know that the markets are going to fall. The third way to do it, and probably a better way to do it generally, is to do what's called a collar strategy. So in a collar, you basically combine both of these strategies and you try to do it for no cost. So no cost out of your account. And what it does is it offers a little bit of protection from the stock going down, but it doesn't offer complete protection. So you basically are going to execute a collar strategy, which is selling one call, buying another put option down below, kind of using the cost of them to offset one another and do it for no cost. And what this does is it allows you to basically get free insurance. And in exchange for it not costing anything, it doesn't offer as much protection as, say, a long put option would. But I think this is probably the better way to go about it, especially if you don't want to do the covered call for some reason, you want to do the costless collar. It's probably a very easy strategy to start executing because it doesn't cost you anything and you always have a little bit of built-in hedge for your position. So very, very easy thing to do. And again, you can learn more about the costless collar on our weekly podcast. Just search on optionalpha.com, and we have a whole tutorial and kind of training on that as well that you can check out. So hopefully this helps out. Until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from optionalpha.com.